Absa released half-year numbers yesterday. We're delighted to have Moses Muthui with us on set. Always a delight to have you, man.
Thank you, Julius.
Karibu sana.
Thank you.
Let's start from here, Moses. I looked at your line in terms of the income coming from commissions from loans and advances. It's down 20%. I'd like us to start from there and spend a bit of time there. What exactly happened in this particular line item so that we're seeing this decline, considering your loan book is up by a similar margin of about 19.5%?
Yeah, so we're very pleased with the performance of our loan book, and the fees that are attached to lending have actually gone up. Other components of our fees around foreign exchange income have also significantly improved given our, our previous investments and increase in margins and volumes. I think the specific decline that you're seeing around the fees on loans is related to an accounting reclassification that we've done with our Timiza mobile lending portfolio, where previously we would book the revenues for mobile lending through fees and commissions, because that's the industry standard and practice. But given our closer look from an accounting treatment point of view, and in line with our internal policies and guidelines, we've reclassified all the revenues from mobile lending and Timiza into interest income, because indeed you earn the revenue when you lend. Sure. So it's an interest related or an income related to your lending activity. So therefore it is interest nature. And for that reason, because of that reclass, which is really just an accounting treatment, moving the fees from, or the income from fees and commissions into interest income, shows a significant decline on fees and commissions. We do expect now that line will be comparable to our lending activity overall and our fees activity overall going into the future, yeah.
Okay. And one of the net outcomes of this is that, sorry, excuse me, your non-funded income as a proportion of your total income has slid down marginally from 32% in the last half year to 30%. So should we make the inference that this is a one-off, because Absa has been very keen of this issue of both engines of the revenue firing properly?
So the way we like to look at the revenue mix, non-funded income over total income, is yes, there's a ratio to pay attention to, which is depending on what happens to your interest income and total income, your non-funded income contribution may either reduce or increase. But we also like to look at it from a growth point of view, because you can increase that ratio by reducing the denominator, right? So we are very focused on making sure that the overall non-funded income continues to grow, and therefore you've seen 11% growth in non-funded income. Now, look at what's happened to our interest income, our net interest income. It's gone up 20%. So really just given the divergence of 11% non-funded and 20% net interest income, it will mean that the ratio will come under pressure from, as you said, 32 to 31 or 30%. But I think our core focus is the absolute non-funded income growing, because then that will demonstrate all your fee activities and your activities around the part of your revenues that are not tied to capital and balance sheet. If that continues to grow and it's 11% up year on year, we are quite pleased with that. I think we've guided that even though we want to see a double-digit growth in non-funded income, the mix over time must head towards mid-30s. So I'm not saying the ratio is not important to us. It is, because overall, your return on equity is dependent on that mix of revenue. But so long as we're doing double-digit growth, the ratio takes a secondary objective than the growth rate.
Okay. Your liquidity ratio is down year on year by a significant margin, from 38 to 30. What's happening there, Moses?
Yeah. So the simple explanation there is the foreign currency funding that we get from our group is deducted from your liquidity ratio when you're doing the calculation. I think so therefore one would ask what has driven up the foreign currency funding that's come from group. So if you look at our loans and advances, about 260 billion, 28% of that, which is 70 billion, is foreign currency assets. We have to fund those assets from our internally generated foreign currency liabilities. 50 billion of that 70 billion has been funded internally, but the gap has been funded by the lines we have from Absa Group. Being part of a group, we have the benefit of getting foreign currency funding from them to cover that shortfall funding. Now, because our foreign currency assets have gone up and our local internal sources of foreign currency liabilities have not gone up as much. It means our borrowing from group has gone up much faster. So therefore, when you look at then your liquidity ratio, when you deduct a much higher component from the lines you get from the group, the ratio reduces. But it's seasonal. We actually think going into the third quarter and fourth quarter, that ratio will correct. In any case, we're still above 20% regulatory requirement. So there's also the question around the cost of carrying excess liquidity. And given as finance managers, you have to also manage the cost of carry. You also don't want to carry excessive liquidity ratios if the cost of carrying that liquidity is also something you have to worry about. So way above regulatory minimum of 20%, but seasonal because of a foreign currency balance sheet, assets and liabilities, and will improve as we go to the end of the year.
And speaking about carrying excess liquidity, your loan book is up by 19.5%. And I'm curious about what pockets are driving this, especially in the present environment where we've seen a bit of amplification of risks, both from domestic and spillovers from the external environment.
So a couple of things. I think the bigger part of it has been wholesale trade. Just given the commodity prices that we've seen elevating first half of this year, our clients who deal in wholesale trading, short-term trade activities, came to us to increase their utilization of short-term trading facilities. So particularly in our commercial business, and so that drove a big part of it. But as I said, it's seasonal. With commodity prices now rolling downwards, consumption of those utilization lines is likely to be lower in the second half than the first half. Secondly, is around mortgages. We see a significant opportunity in the mortgage market, and our book there has grown significantly. We also very much in SME, and our business bank has gone up in terms of its balance sheet as we support the economy and make sure that we are participating in the growth engine. So I'd say wholesale trade, secured lending in retail, which is mortgages plus, and then business banking. We've seen a faster growth in our wholesale balance sheet in terms of loans and advances more than our retail side, which is a good space to be in given the cycle we're in. We're almost like in a defensive cycle, and so we like that mix.
Okay. Asset quality, still on the pressures coming into the domestic environment. We've seen your NPLs going up, but the ratio is still single digits. Looking at the risk profile going forward, what do you expect around that?
So we are very pleased with the portfolio quality we have. NPL or non-performing loans ratio at 7.8%. Around the 7% mark. Overall, non-performing loans have only gone up 8%, from 18.3 billion to 19.7, which is give and take 1.4 billion. Now that's 8% when our loans and advances are up 19%. So you can see in terms of the timing differences, we actually riding lower non-performing than the production of our loan book. And again, you have to also reflect on when we were navigating through COVID, we took certain charge-offs for the small part that was never regularized, about 5% of our restructured loans. And after 12 months, you have to write that off. So we've been very prudent in writing that off, and that has contributed slightly to that increase. In terms of outlook, we can confidently signal, not state, but just signal that we are likely to continue running below the industry average.
Significantly below.
Lower than the industry average. And I guess it's a function of your starting point. And then once you do your stress tests and you look at your sector exposures and where most of the non-performing loans are coming from, and you look at our balance sheet where we don't have a single sector exposure above 10%, it's fairly diversified, then you can largely then say it might increase but below industry average for as long as we continue to manage our loan loss ratios and broader profitability. And then continue to be prudent on writing new loans, because these things are cyclical, right? Yeah. And our stance has been very prudent. The trick part is there are also growth sectors that you have to fund that might be problematic down the road. When you put all these things together and you look at our history and where we are and where the industry is, we are quite confident that below industry is a place we can sustain.
Absa seems to be going countercurrent. A number of your peers are winding down on the loan loss provisions. Right. What explains this, Moses?
Yeah, so I think at the face of it, you could argue that, you know, people are seeing a more optimistic outlook. We have slightly, when you look at the details, a little bit of a contra view, that we are not yet at a point where we can release all of our forward-looking provisions. So last year we released 600 million. We still have 1.5 billion plus of forward-looking provisions that we are still sitting with. Just sort of like a war chest for any unknowns. We have to balance that out with how the economic cycle evolves. And I think there's an evolution from here. So I think it's a sense of how you read the environment and whether you're confident that your income statement and your balance sheet performance is where you need it to be. Because at the end of the day, provisions is about judgment. Yes. And as a management team, we like to err on the side of prudence when it comes to judgment in terms of provisioning. So we've taken a slightly defensive view. And here's the upside. You know, if there's an upside down the road, we release the provisions. If there's a downside, then we're prepared for it. So net, I think it's a fair decision in terms of how we looked at it.
And speaking about being guarded about what the maybe near to medium term looks like, let's talk about the dividend. I thought, considering the sort of earnings that we saw, both top line, bottom line, holding the dividend flat at 20 cents a share was not really generous of Absa.
I think paying an interim dividend in the environment is perhaps can be seen generous when you look at relative basis, right? So look, I think for us the dividend decision was a fairly straightforward decision, well considered but straightforward decision. There are three things that we considered, as we always do in these type of decisions. One is there's a test of whether you have adequate capital to fund your growth. So last year we closed with our Common Equity Tier 1 capital ratio at 14.6. After funding the net growth, we ended up at 14.4%. That is still 2.4% above our internal target, right? And significantly higher than 10.5% of where the regulator wants us to stay. So then we looked at that and said we could actually expand our balance sheet by 70 billion of Kenya shillings of assets without touching our internal regulatory minimum. So we said we've actually got the potential to fund future growth. So we are not, we are not running capital ratios where we are worried about whether we can grow. So that's the first test. The second test is whether your capital can afford it. Because we signaled coming out of COVID that our dividend policy is going to be to the extent capital can afford it. And so you look at 14.4% of our capital ratio, and where we are after paying the interim dividend, which is 14%. So it was a 40 basis point decision. It wasn't a material decision in the sense of capital affordability point of view. But I think lastly, and to what you asked, is are we prudently provisioned for any eventuality as we look into the medium term? And as I said, with forward-looking provisions still intact, not having been released this year, then we said that we are actually positioned for a stress environment in the event of an unknown. So when you look at whether you can fund growth, whether you can afford, and whether you can manage uncertainties, those three things triangulated to making a fairly straightforward considered decision to pay the interim dividend, which we've done.
Okay. One of the things which, again, stood out to me as Absa being countercurrent is your income from foreign exchange trading. Right. Because if you look at a number of the peers, given the sort of environment we are in, with the kind of spreads we've seen banks enjoying, the income is up by a significant margin. I didn't seem to see that with Absa. What explains that?
Yeah, so I wouldn't talk so much around why their growth rates in FX is in the percentages you've seen. I think for us to explain a lower percentage and perhaps still a very decent growth of 44% is both trade volumes are up in terms of trade activity. Of course, you've seen supply chains opening up, more trade corridors being activated, more trade happening, and therefore banks participating in that volume upside. But secondly, is the spreads have also widened. You know, when you look at what we strictly do, which we stay within the Reuters or guided spreads, which we strictly must, it's really, you're talking about 10 to 20 cents spreads expanding to 40 to 60 cents spread. So I can only talk about what we do, which is obviously those thin expansion of the spreads have also contributed to that. So do we see those growth rates continuing? I don't think to the pelt at which we've seen the percentages, but FX income will continue to be a significant source of diversification for us. And I think the future is going more towards structuring as opposed to buying and selling currencies. What structures can help people manage risks? And that's actually how we are thinking about it.
All right. Moses, something you and I have discussed before, maybe ad infinitum, is that the issue of the green light from the market regulator around the risk pricing model. You indicated yesterday that Absa got this finally. How is the road ahead looking like?
So we're very pleased and quite thankful and appreciative of the regulator for the risk-based pricing approval. Obviously, from the approval stage, there has to be an implementation plan. As you can imagine, our systems have to be re-looked at. Our processes have to be re-looked at. In the view of treating customers fairly, communication and engaging our customers has also to be re-looked at. And then we have to think about products that then go along with the approval to make sure that we can benefit from that approval for the sake of our customers in terms of new products and solutions. So there's a phase of implementation planning that we are currently going through. Potentially early parts of next year is when we feel we'll be ready. If not a little later, but there's that space between now and then, which is just the planning phase of it.
Okay. And what sort of guidance can you give in terms of what should we expect from sort of ceiling floor perspective as far as pricing is concerned?
So I think the ceiling floor discussion on risk-based pricing, the operative word is risk. And therefore, it really depends on the risk environment at the time and what that risk environment means for risk profile of different borrowers. So it's very difficult to give any answer on this is the floor and this is the ceiling. You have to apply your mind around it based on the risk environment you're in and risk profiles. Because remember, the great thing about risk-based pricing is differentiated pricing, both higher pricing but lower pricing based on risk profiles. But also risk profiles for borrowers are subject to the risk environment we're in. Now, if you asked anyone to guess what risk environment we'll be in, it will be difficult to do that. So we will wait to see, and then all this will be public communication to our customers and borrowers. And the good thing about it is it will stay dynamic. So I think that's an answer we will only find at the time.
Okay. I'd like us to close this conversation by talking about the external environment. So we've seen global financial conditions tightening, the Fed, etc., are hiking. What sort of transmission are you seeing locally, and what does it mean for your operations?
Yeah. So I think when you look at the two parts of the global financial markets or global economy that really have got high transmission into our continent, there's the US and there's Europe. I think the US, the regulators are very much focused on inflation stickiness and trying to deal with a sticky inflation environment where wage prices have gone up, inflation has rallied, trying to deal with that without damaging economic growth and economic activity. So there's a fair balance of what needs to happen. I think that, we'll get to hear from Jerome Powell and his committee in the coming weeks. But I think there's an old adage that, while macro stability isn't everything, without macro stability, you have nothing. So I think they have to do with inflation is really something that that we are keenly looking at, which might mean increased rates in the US or a faster increase in rates in the US to deal with inflation. I think in Europe, it really depends on the geopolitics around Russia, Ukraine, and what that does to prices of energy in places like the UK or Germany going into the winter season, and whether that might trigger lower consumption of Kenya exports, whether it's horticulture or tourism. And then in the US, you've seen US dollar remittances into the country have actually started dropping. So I think the two transmissions we see, not just in Kenya, but I think within the region, is what happens to remittances, but also what happens to exports in markets like Europe with this geopolitical situation, and also inflation pressures in the UK. Those are the two signals to look out for in the short term.
Okay. And maybe now final, just piggybacking on that point, is that the domestic FX environment has been equally tightened for a while. What's your experience so far as Absa, and what do you see going forward?
Yeah, I think we are very much open to servicing our clients and client flows based on supply and demand of currency, and certainly that's what we do. And we like the fact that the economic environment, particularly on the trade side, there's a lot more activity going on the trade side. And as I said earlier, just in terms of the increase in our foreign currency lending, that we've seen faster growth in the first half than previously, to now 28% of overall assets and of overall customer assets, just says to us we are continuing to service our clients in terms of supporting their trade activity. And we just hope that those trade activities continue, and banks like ourselves and the industry can stay behind driving the recovery of this economy. And really always remembering that we are here to help clients transition through good and not so good economic times. And I think that's really the primordial role of banking. How can banks stay the course with their clients through and through? And by the way, I think with COVID, we've demonstrated we can actually do that. So I don't think any other challenge will be insurmountable, generally speaking.
Moses, let's close it there.
Thank you
so much for your time.
Thank you very much.